Hey everybody, I hope everyone is doing well and had a good day. In this video, we're going to review the E-mini S&P 500 5-minute chart for Wednesday, May 27th, 2026. Just quickly, the daily chart context going into the day. The market's in a bull trend. We had this trend line break, so it's a pullback in a bull trend. The channel up is tight. The selling pressure is relatively weak. We have a pullback, the market's channeling with higher highs and higher lows, and now we have a micro channel to a new high. This bar all the way to the right that we can see is yesterday. For the bears, they're hoping that it's a tight bull channel, possibly a break below a major higher low because the market pulled back here and then broke out strongly to a new high. Then we had a bear breakout, trend line break, breaking this tight bull channel trend line, and again falling below this higher low. So the bears are hoping it's a trend line break, retest of the highs, and then maybe we get a higher high major trend reversal where the market reverses into a bear trend. One of the problems with selling here is that if you sell below the bar, you're getting relatively small risk. This is the daily chart, so it's about 50 points of risk, but based on this chart, if we didn't have the time axis, the bar is relatively small, maybe an average size bar, but you're selling looking for a major reversal or at least a test of these lows down here, the support. So you're getting good risk reward, and that means you have low probability. The opposite side of the trade, you have to think about the context. The market is in a bullish regime. Every bar for the past 20 bars and even more have been completely above the moving average. And now we have a 5-bar micro channel going into yesterday. So the odds that selling below yesterday, selling below this bar's low, result in a major reversal, it's a low probability trade. And if it's a low probability stop order sell, then it's a higher probability limit order buy below the bar. So I expect support at yesterday's low. If we do go above yesterday's high, the market's channeling up, like I said. Now that we broke out to a new high and got a bear bar, there's probably traders selling above yesterday's high, limit order bears selling to get short, and bulls taking profits at resistance. And then here's the 5-minute chart. So we look at the context going into the day. The market is in a trading range. We had the sell-off, and then you can call it a triangle, breakout mode. The bulls had an attempt at, so basically bear trend, trend line break, a two-legged retest of the bear trend's extreme, and the bulls have an attempt at a higher low major trend reversal. And the bulls got a decent breakout here, a pullback, another leg up. But we're still within this bear trend back here. I'm also going to add one level of resistance back here. The reason I'm using the bar 12 low, at least on this chart, it looks like it's a micro channel up to bar 11. 12 is a trend line break. The bulls got another attempt up. And here, let's look at it in real time. The bulls were hoping bar 18 would become a double bottom bull flag. So it's a bull breakout, a pullback, attempt at trend resumption that failed, and then a second pullback. The bulls are hoping for a high 2, basically a double bottom with 12 and 18. But instead of getting the double bottom and then trend resumption, there was a bear breakout that led to lower prices. So any trader buying here got trapped by the bear breakout and follow through. So I want to keep that level of resistance because the odds are, if the market comes back and tests this area, there will be resistance, sellers here. I have yesterday's high marked, and then that breakout point, the bar 12 low. And then I have yesterday's low also in blue. The market gapped up going into the day. To me, I see 3 legs up, at least 3 legs up. 1, 2, 3. You can draw a channel line like this, or maybe something. I prefer overshoots rather than undershoots. So I'd rather connect the highs of bars 59 and 77 and then have an overshoot where bar 1 exceeds the channel line just by a little bit. So bar 1 testing that bull channel line as the market's creating higher highs and higher lows. The market is technically in a bull channel, but it's leg 3. In the big picture, it looks like the market's in a trading range. It's not clear that one side is definitely in control. We had the sell-off yesterday, the trend line break, a lot of sideways price action through here. And the bulls are hoping that it's a major reversal into a bull trend. But again, let's see if the bulls can break out of this channel line and the resistance to the left from yesterday. Bear bar on bar 2. It's a breakout bar below bar 1. Bars 1 and 2, they're both overlapping each other, and bar 1's a doji bar, bar 2 also a trading range bar. There's probably sellers above 2 and buyers below bar 2, and it's probably going to be a trading range on the open. At this instant, it's technically a bear trend from the open. You have a trading range bar on 1, bear breakout bar 2. The bears are hoping the market continues to just drift down. Maybe it's a bull trend, trend line break, retest, and then major reversal. But the structure for this major trend reversal is not very good. The selling pressure through here is relatively weak compared to the buying, and there's open bull breakout gaps. So whatever the bears get here is probably only a minor reversal, and the bulls may need to get at least one more leg up. Another thing with that, most days, bar 1 does not remain the high or the low of the day. This is a fun little study you can do. You don't have to do hundreds of days of data. Even if you take a random set of 100 days, go back a couple of months, and just mark how many times bar 1 is the high or the low of the day. You're going to see that it only happens about 20% of the time. And that's, you hear Al talk about the stat, you can hear me talk about the stat, but it's really different when you do a kind of a simple study like that yourself, just to see that it kind of makes the stat your own in a way, if that makes sense. Rather than hearing someone else talk about the study or the stat and repeating it, that's something that I used to do for sure. But I've learned through time and through listening to Al Brooks and listening to Ali, listening to Brad Wolf, you have to really do the studies yourself and produce. You have to produce artifacts, basically, the way Ali puts it. You have to, whether it's videos like I make here, or whether you produce trading systems, produce studies, and just to kind of get back on track, the whole point is that it's unlikely that bar 1 remains the high of the day here, and most days have a trading range on the open, so we're probably going to have to test the high of bar 1 at some point today. Bar 3, a big bear breakout bar. That's good for the bears. Second leg down is likely. However, because we haven't gone above bar 1 yet, that is a problem. That hurts the bear case here. It's a bear trend from the open. But as the market approaches support, the bars to the left, we have to see, will the bears continue to sell, or will we find buyers? Maybe the low close, bar 66, anywhere in this area is support. Market sold off for a couple of legs sideways to down, went sideways for 4 bars here, then got a strong bull breakout. Now the market's testing this trading range, the breakout points basically down here. So between these lines is probably support. And the market bounced, went sideways, bar 4, it's an inside bar, probably buyers below and sellers above. And then 5, a bull breakout bar. As far as the trader selling above bar 4, bar 5 is a disappointing bar. If you sold above 4, you're expecting lower prices, but instead you got a breakout bar, the market went against you, and then bar 4 basically closed at your entry price, which is not ideal. If you're selling above 4, you're hoping the bear breakout, the micro channel, gets a second leg down. It is likely to get a second leg down, but now we have a trading range bar on 4 and then a bull breakout on 5, and bar 5 may need to get a second leg up first. And that's what's happening on bar 6. Also, lower time frame chart, you could see it's basically the 3 bars on the open is a bear trend. Bar 4 is a trend line break. Remember the tail of a bar. The market rallied on 4, then sold off. So it's a bear trend, a trend line break, a retest of the low of the trend, and then the bulls are hoping it's a major trend reversal. I'm calling it a major trend reversal based on the pattern, but the structure is only happening over the first 6 bars of the day. So you'd have to look at a lower time frame chart, like the 1-minute chart, to really see what I'm talking about. But basically, bear trend, trend line break, retest, and then the bulls buy. They're looking for at least a test of the high of bar 1. But it looks like a trading range on the open. Big down, big up. The bears are expected to get a second leg down. The bulls are expected to get a second leg to the upside. 7, bull breakout bar. It's a good-looking bar for the bulls, but that channel line is still relevant. So if we can extend it to the right, we can draw it like this. And now it's at least 1, 2, or 2, pull back, 3 legs up in a bull channel back at that resistance area. Even if we didn't see the bars to the left back here, we can see that bar 1 rallied to its high and then sold off for a lot of points. So when bar 7 comes back and tests up here, we can expect resistance. So it's leg 3 on a channel line at resistance. This is a good example of a bar that the way I try to think about breakout bars, I try to keep it simple and think about it in terms of binary decisions and ask myself on every breakout bar, is it more likely that, in this case, is it more likely that the bull breakout is going to continue and rally for a measured move, or is it more likely to pull back or reverse and run the stops below the bar? So the binary decision is, it leads to, there's really 3 outcomes when you're trading, when there's a signal. First of all, you need a signal generator. So I talk about it as breakout bars. Breakout bars are the signal. And then you have to ask yourself, is it a signal to take the breakout or fade the breakout? Or it could be a signal to wait and do nothing. And take means to enter in the direction of the breakout. Fade means to take the opposite side of the trade. So in this case, bar 7 is a bull breakout bar. To take it would mean to buy, and to fade it would mean to sell. So the question ultimately is, okay, here's a signal bar, bar 7. Should I buy the close, put a stop below the bar, and go for a measured move up, test of yesterday's high? Or should I take the opposite side of the trade, sell the close of the bar, put a stop up here, and a target at the low of the bar? For me, one of the things I've come to understand from studying Al Brooks and Al Lee and doing my own market behavior studies and just looking at a lot of charts is that these breakouts like bar 7, it's a bull breakout bar, but it's right on a channel line, which is resistance. It's also testing this breakout point back here, which is resistance. And the overall structure looks like it's a wide trading range, where basically yesterday's range is the trading range, and we're in the sell zone. We're in the upper third. We're testing resistance. So we have 3 legs up to resistance in a trading range. And for a system that is looking to capture breakouts and second legs, one of the most important filters is leg count. And when you have leg 3 in a channel or a trading range, especially with significant selling pressure, like, okay, through here, the selling pressure, not too strong, but once you get the micro channel on the open, now it looks like it's a more broad channel or trading range. There's probably sellers above 1. So you get bar 7, a bull breakout in leg 3. To me, this is a signal that gets filtered out, which means do not take the bull breakout. And because of the law of polarity, everything has an opposite. If your system is telling you to filter bar 7 out, in other words, do not take bar 7, don't buy bar 7, the law of polarity tells you that you can do the exact opposite. So you can sell the close bar 7, you can fade it, betting that the bull breakout fails. And that is in alignment with Al's 80% rule. 80% of breakout attempts of trading ranges fail. It's a late leg, it's at resistance, and it's really not even breaking out of anything. If you look to the left, it's still not breaking out of bar 1. Bar 8, it's a pullback on bar 8. The market sold off to the low of bar 7. Now, something interesting happened here with bar 7 and bar 8. It's a 5-bar micro channel up to bar 7. That's significant buying pressure. That's a decent micro channel by the bulls. Micro channels usually get second legs before they reverse. So bar 7, I was explaining how I don't think it's an ideal place to be buying on bar 7, on the close of bar 7. If anything, I'd rather sell the close of bar 7. But then when you get bar 8 going below bar 7, you're at a profit target for the bears fading the breakout. Some of them will take profits at the moving average at the low of bar 7. But you also have bulls who are going to be buying at the low of bar 7. It's about a 50% pullback of the rally, and it's buying below the last strong bull bar in the rally. So you're going to find buyers here a lot of the time. The market will at least hesitate, go sideways to up before reversing straight down. So what happened here? Traders sell the close of 7, bulls take profits, and bears sell to go short. But then those bears that sold, I believe a lot of them take profits around this area, the moving average and the low of bar 7. And you can see the reaction with the tail on into the close of bar 8. There's buying pressure into the close of bar 8. And now we may have to go at least a little more sideways to up before we sell back off. Again, I think the micro channel on the open, bars 1 through 3, usually gets a second leg at least sideways or down. And it still really hasn't had that yet. It's had a deep pullback. It pulled back about 100%, but it still could get that second leg sideways. For the bulls, the micro channel probably will at least get some kind of attempt at a second leg, but because of the breakout bar on bar 8, this resistance, it's proving to be resistance here. The market attempts to get to this breakout point. I'm using the low of bar 12 yesterday. You could simply use the high of bar 1. Market reaches the high of bar 1, sells off, tries to get there again, sells off again. Then you also have to take into consideration the traders who bought the close bar 7, immediately trapped into a losing position. If you bought the close 7, you're disappointed with your entry bar. You're just hoping that the market gets back to your entry price so that you can exit at your original entry at break even. And that's another reason that there's probably resistance up here between the close of 7 and the low of bar 12 yesterday. So probably sellers above bar 8. Selling directly below 8, not ideal with the tail and with the support, the rally, the pullback, the second leg likely. The bulls get their second leg, 9 and 10. It's another micro channel, but this time it's maybe leg 4. 1, 2, or 2, 3, pullback, 4 legs up to that resistance once again. So bar 10, another example of a breakout bar that might be a better opportunity to sell than to buy because it's a late leg at resistance in a trading range or a channel once again. So 10 might be a better sell the close bar, even though it's a bull breakout bar. The signal is open to interpretation. That's another one of the things about price action trading when you're doing technical analysis. Anyone who trades price action, nobody's trading the market. Everyone is trading their beliefs about the market. So you really have to inspect, what are your beliefs? What is it that you believe? Why do you believe it? What's the evidence that what you believe is true? Is it reliable? That's how you have faith to act on a system. And no one can really just hand you a system and do the work for you. You've heard that you reap what you sow, or you get what you put in. It's all the same thing. And it's true in price action trading. as it's true in everything else in life. You get what you put in. And again, what's the evidence that what you're doing is reliable? Have you done the studies to back up your actions? Are you being disciplined? Are you following your trading plan? All these things are important, but only you can answer those questions, and only you can interpret the chart in front of you and tell yourself, okay, bar 10 objectively is a bull breakout bar. It's a trend bar closing near its high. It's breaking out above the high of the prior bar. To one trader, it's a buy signal, and to another trader, it's a sell signal. And you have to take the information that's given to you and interpret it and decide, is this a take, a fade, or a wait? Bar 11, a big outside down bar, good for the bears. It's a bear breakout bar. The structure, it's 3 attempts up here, so you can call it a wedge, even though it doesn't look like a wedge. It's a double top with bars 1 and 7 or 8, and then a breakout attempt above that double top that failed. So bar 11 structurally may not look like a wedge, but functionally it should function like a wedge. So because this is happening near resistance in an overall trading range, you expect at least a couple of legs down after bar 11. So 11 likely to get a second leg down, reasonable to sell and scale in, again expecting a second leg down. Follow through bar on 12, there's probably sellers above 12 scaling in, expecting a second leg down. Now that the market's testing support back down in this area, we may bounce. The problem with selling down here, the market's in a trading range. You can tell on the open with all the overlapping bars, big down, big up, every bar overlapping the prior bar. It's a trading range, and traders are going to buy low and sell high. And as the market tests lower in the range down here, we're finding buyers. But as it tests higher in the range, we're probably also going to find sellers. Now, outside bar 13. 13 looks like a bar that probably doesn't matter if you buy or sell 13. If you manage your trade correctly, you're probably going to make money because it's right in the middle of the trading range. So even if it goes down first, it's probably going to come back and test the middle of the range. And even if it rallies first, the bear breakout's strong enough for a second leg down, and it looks like there's resistance up here. The evidence on the chart is showing that there's resistance up here. So you can sell, scale in higher, you can probably buy, scale in lower, and at least make a scalp. The bulls, the target for the bulls, the upside is probably limited based on the bear breakout. It's already testing the breakout point, some resistance there as bar 13 sold off into its close. We may go a little bit higher, but I don't see it going much higher than the close of bar 10, this upper part of the range, unless the bulls get a surprise. It looks like a trading range, and it's probably going to continue to go sideways and be a trading range. Bull breakouts are going to fail up here, and bear breakouts are failing down here. The market's oscillating between support and resistance. Bar 14, it's a breakout bar for the bulls. Again, if you're counting legs, you have at least 3 legs up. Maybe this is 4, maybe it's 5 legs up. It's a lot of tests of resistance up here. If you just count how many times the market tested here, 1, 2, 3, this is the 4th attempt of this resistance area, and it's still not breaking out yet. So the bulls need at least 1 more bar, and then a follow-through bar would also be good. So bar 14, it's a bull breakout bar, but it's in the upper third of a trading range. Because of the context, late leg, and near resistance in a trading range, there might be more sellers above bar 14 than buyers, even though it's a bull breakout bar. And then 15, it looks like there were limit order traders selling above 14. We have a breakout bar, or a reversal bar 15, bear breakout, a pullback. The bears are hoping this continues down and the bears get a second leg, but it's mostly going sideways through here. The market is in a fairly tight trading range. Breakout bar 16. Good for the bears, reversal and follow through. There's probably sellers above 16 and inside bar 17. It's an inside bar in the middle of a fairly tight trading range. There's probably sellers above. There might be buyers below, but the buyers may not come in until the market gets lower in the range, closer to support. 18, bear breakout bar. Now it's a micro channel for 4 bars. Second leg down, likely. And the market paused. 19, 20, a bull breakout bar. Now at this point, bar 8 broke out below 7. We have leg 1, pullback, leg 2, pullback, maybe leg 3, truncated wedge bottom near support. So bar 20 being a breakout bar for the bulls, it's a bull breakout bar. It broke out above the high of 19. It's closing near its high. The bulls can call it a wedge at the bottom of a trading range, and also the third leg subdivided into 2 pushes down here. That's all good for the bulls. But if you're buying above bar 20, the market's forcing you to buy in the middle of the trading range, which is really not ideal. It's better if you can maybe buy below 20 or 19, or even down here at the low of 13 or 3. Some traders will take the buy on 20 and scale in lower. They know it's a trading range, and if they're buying here, they're probably not trading. They're probably not taking a full size position. They're trading small enough so that if the market goes against them, they can scale in. I talk about this all the time also. The micro channel 15 through 19, even though there's a pause, every low, every high is at or below the high of the prior bar. The micro channel is probably going to get a second leg down, or at least going to hesitate and go sideways before reversing back up. So it's unlikely that we go from straight down into a bull breakout. And then the market got one more leg down with the reversal 21 and then bear breakout 22. It's testing that channel line once again. This time more clearly, 3 legs down, third leg subdivided into 2 legs, and then testing this support once again. So it's another one of those breakout bars that is kind of like bar 7 and bar 10, but the opposite, testing a bear channel line in a late leg at support in a trading range. So would you rather sell the close, bar 22, looking for a measured move down, or buy the close and looking for a test of the high of the bar, put a stop and measured move down? Market ended up reversing on 23. It's a decent buy signal bar, and structurally it looks okay for a swing trade. Traders will, bears probably exit above 23, and bulls can buy above 23 for a swing trade. This is a fairly tight channel down, so the only problem with buying here is that this is a breakout on a higher time frame chart. And even if it rallies, you're going to have trapped traders maybe around the midpoint of the sell-off. That takes you around the close of bar 22, which is also resistance, because any trader, if they bought the close 20 or bought above 20, the market ended up reversing down, trapping them into a losing position. So when the market comes back to this area, moving average is resistance, the bar 20 close is resistance, the 50% pullback of the tight channel is resistance, and we can see the tail on 25 reacting to that resistance. The traders who bought scaled in, they're taking profits around their original entry. Buying 23, those traders are also taking profits. Now the bulls have a micro channel, and there's probably buyers below. 25 is not a very good stop order sell, so there's probably traders buying below 25. But again, the micro or the tight channel 15 to 23 is a breakout on a higher time frame, and it may get a second leg down. We have a trend line break, but now we need a retest, probably at least a test of the 22 close, which is basically this red horizontal line I have drawn. And then 26, another bear breakout bar. It's just another bar added to a late leg in a channel on a trading range day. There's probably buyers below 23. The traders that were it's a stairs pattern. If you're buying below 19 and scale in, you make money. If you're looking to buy below 23, willing to scale in lower, you're probably going to make money. One of the things at this point in the day, the range is fairly small, maybe 50% of an average daily range. If the average is about 50 points, this is a 25-point day at this point. So the daily range can double, and it's likely that the market at least tests the low or the high of yesterday. And from where the price is currently, the close of 26, yesterday's low is right below, the high is all the way up here. So the market may have to test yesterday's low before reversing back up. But also, with that said, we talked about it on the daily chart. The context for selling below yesterday's low is not very good. So there's probably buyers around yesterday's low. And the 5-minute chart context supports that as well. It's a trading range, and traders are going to buy at support. Extend this to the right. Bar 27 breaking below the bear channel line. It's a late leg. You can count at least 3 legs down, and then the market is approaching support, yesterday's low, so probably the downside here might be limited. And then pausing, bar 28. It's a micro channel from 25 to 28. There's probably sellers above 28 for a scalp. It's likely that the micro channel at least gets an attempt at a second leg down. So the first trend line break more likely to fail and pull back, and then maybe the bulls can get a second entry long. But for the bears, like I said, it's a late leg near support, so the downside here is probably limited. I'm more expecting the market to find support and to reverse back up, for this to be a trading range day, and for this to be, a few legs down for the bears that are eventually basically retraced, and that the bulls then get a couple of legs sideways to up, and the market continues to go sideways. I think it's unlikely that it's a bear trend day. It's unlikely that we find traders aggressively selling below yesterday's low. And we can see when bar 28 tested yesterday's low, we found buyers, and the market paused. So there's the first trend line break of this micro channel, 25 through 28, bull breakout bar. But again, it's more likely that this leads to hesitation, a sideways to down second leg for the bears. It's about a 50% pullback of the sell-off. And it's the first trend line break, and it's breaking above bar 28, which is a trading range bar. And a trading range, traders buy low and sell high. So more likely traders selling above 28. The bulls were not eager to buy above 28. I think the bulls are more eager to buy above a bar like 23. There's momentum. The bar is closing basically on its high. But here, the bar is closing around its midpoint, and there were sellers at the high of the bar, so there might be more sellers up here. And the momentum down usually gets a second leg. Hesitating, it's another channel here, kind of like back here with the overlapping bars. Rally 28, pullback, rally 29, pullback, rally 30, but double top. Maybe a double top bear flag on a lower time frame, bear breakout. 2 or 3 legs sideways to up to resistance. 31, outside down, bear breakout. This is the hesitation I was talking about, why buying is not ideal, like buying above 28 or buy the close 29, because the micro channel is probably going to lead to hesitation and get a second leg at least sideways to down. And that's what's happening here. Micro channel, pullback, test of the lows. The traders who sold at close 27 or sold at yesterday's low, they're trapped by the pullback. They're disappointed by the rally. And they may use 31, maybe buy below 31 to exit around their break-even price. If you sold 27, scaled in higher, market came back to your sell the close entry, and that might be support. Also, just the structure, trading range overall, many legs down in a channel. It's more likely going to correct for a couple of legs sideways to up, than get a strong bear breakout that resets the market cycle and sends the market into a stronger bear trend. That's the 75% rule. Bear channel is a bull flag. 75% of the time you get the bull breakout. 25% of the time, the lower probability event is you get the bear breakout below the channel line and then acceleration into a stronger trend. So probably buyers below 30 and 31. And then the bulls get a second reversal. So the channel down, the micro channel, first reversal, pull back, second reversal, 32, a more reasonable stop order buy, second entry long, bull bar closing on its high. You're expecting at least a couple of legs up after this channel. Probably resistance here and here. But strong enough bar, 32, that buying is okay, scaling and lower, reasonable. 33, not a good stop order sell, probably buyers below. 34, reversal bars outside down, but relatively small bar, and the micro channel, 31 through 33, second leg up likely, so probably buyers below 34. The bulls basically got a spike and channel through here. The selling pressure through here is weak. There's an open gap, and selling below 37 is not a very good stop order sell, so probably buyers below, going at least a little bit higher. And then another micro channel through here. Outside down, 41. It's a good bar for the bears. A second leg up is likely after this tight channel, but 41 is a strong enough bar near resistance that it's reasonable to exit longs below it. The market may pull back here deeper than you want it to. You have to look at the bars to the left, and even though it's a pretty tight channel, it's occurring within an overall trading range on a trading range day. The bears get a follow-through bar, breakout follow-through, second leg down, likely. That means the first reversal attempt, if the market goes above bar 42, there's probably sellers above 42. Now it's a 3-bar micro channel. So the trading range price action continuing where it's kind of a big up, big down situation. The bull breakout, this rally is likely to get a second leg up, but now we have a 3-bar micro channel to the downside, which is likely to get a second leg down of its own. So we may have to continue to go down for a second leg before the bull breakout, the bigger bull breakout, gets its second leg. And then 44, a big breakout bar, probably the biggest bar of the day. 3 big legs down, bar 3, 28, and 44. 44, like I said, a big breakout bar. Big breakout bars on trading range days are usually traps. They trap traders into doing the wrong thing. It's a big bear breakout bar. Traders kind of panic into selling. They think they have to get short. There's momentum, but they fail to realize it's 3 big legs down, testing the channel line and yesterday's low support once again. And just ask yourself, what happened the last time the market tested yesterday's low? It rallied for a lot of bars and a lot of points. So when the market comes back and tests here, we know it was support last time. There's probably traders buying below bar 28 and yesterday's low. Also 44 being a sell climax, it's a big bear breakout bar. The traders who already sold, if a trader sold 41, 42, 43, they sold anywhere. 44 is a windfall of profits. It's a sudden huge gain in your favor, and a lot of traders will take that, especially on a trading range day when you're selling and the market's testing support. So once again, it's a big breakout bar with very little overlap, but the context is not great for selling. And you have to ask yourself, would I rather sell the close 44, sell a big third leg down to support on a trading range day and expect to get a measured move down, put a stop above the bar, or should I do the exact opposite, buy the close, stop down here, target up here? And that is up for you to decide. 45, an inside bar for the bulls. It's good for the bulls. Bull bar closing on its high. A trader selling for any reason, they have to recognize that it's 3 legs down to support, and now you have a bull bar closing on its high. It doesn't matter if you sold 41 or if you sold the close 44. It's a reasonable bar to exit shorts above on 45. And then it's a follow-through bar, breakout bar 46. This rally is likely to get a second leg up. It's testing support low in a trading range. So reasonable buy the close bar, buy below the bar, scale in, expecting a second leg up. Also the rally, like I said, through here, this was a strong rally. Probably going to at least test the low of bar 40. That may end up being resistance. 3 bar, 4 bar micro channel, first reversal, probably going to fail. 48, relatively small bar after the micro channel. More likely buyers below 47 and 48. And then the bulls get resumption. 50, another example, bar 50. It's a tight channel. It's a reversal bar, but not a very good stop order sell. So when you get bar 51, it's another one of those examples of the lottery ticket kind of trade where a lottery ticket gives you great risk reward. You pay $5 to maybe make $1 million, but you know your probability of winning that jackpot is close to 0%. And there's trades like this every day in the market. That's kind of the way I see these trades, like the first reversal after a channel or after a micro channel. 41 is an example of one that worked. And I don't want to get into it and get too sidetracked with this end of day review. But we talked about the tight channel reversal down bar 41. It's a strong breakout bar for the bears. It's testing resistance. It's a reasonable bar to exit below. Usually you need less reason to exit a trade than to enter one. So I think it's definitely reasonable to exit longs below 41, but to go short is more aggressive because it's more likely that the market's going to hesitate and go sideways than go straight down. So it's better to look for a second entry short here, but in this case, this one went straight down. But we talked about it several times, like I think we talked about it back here on bar 7. Micro channel, probably buyers below the first pullback, second leg up likely, which the bulls got. Even this one, micro channel, first pullback below 15, hesitated for a bar. Tight bear channel, micro channel down to 19, probably sellers above. Another micro channel down to 28, probably sellers above, hesitation, sideways more likely. Micro channel, first pullback, buyers below likely. We talk about this all through the day. And it's the same thing happening here. Micro channel, probably buyers below. Another micro channel, overall tight channel, bad stop order sell, buyers below, more likely. And the market's continuing to channel up here. 54, now you have 3 legs up, approaching resistance. I think it's okay to exit longs below 54, but selling 54, again, is one of those lower probability trades. So if you're okay with the low win rate and the good risk reward, then you can take 54. Otherwise, there might be more traders buying below 54. And the channel continuing up. Probably resistance here. So we hesitated near the breakout point. Market accelerating. Strong 3 bar micro channel, 56, 57, 58. But there might be at least some hesitation here. This looks like a strong enough rally that any reversal attempt the first reversal attempt will fail. And in this case, it really didn't even get a reversal attempt at that resistance. Micro channel continuing. First reversal down will probably fail, so traders will set limit orders at the low of every strong bull bar. They'll set an order to buy below 57. It doesn't get triggered. Buy below 58, 59, 60, 61. They finally get triggered. Maybe it's below 60. Or they bet the trading range bar 61 is not going to succeed in reversing this micro channel. So they buy below the first pullback and look to scalp. But now that we've had a pullback, the market's in a channel phase. This is probably sellers above 61 on 63. Another reversal, 64, but a very tight channel, probably buyers below. Selling pressure through here, especially through here, non-existent. Back here, fairly weak. So this is a pretty strong leg up, and whatever reversal the bears get will probably be minor. So once again, buyers below, and it leads to another leg up. It's a spike pullback channel, which now we have 3 legs up. We're near the high of the day. Maybe the spike in channel evolves into a trading range, and the bears get a test of the start of the channel. Remember, in theory, some trader sold the low of bar 62. They got trapped by the rally here. And because of that, that creates support. So there's probably buyers down here near the low of bar 62. 3 legs up near the high of the day, 69, reasonable bar to exit longs below. Another swing trade for the bears. Relatively small risk, reward probably at least down here. Now it's a 3-bar micro channel, probably sellers above 70, and this will probably get a second leg down. And the bears end up getting their target. You can see the tail on 72, traders buying near that support, the start of the channel. Again, spike, pullback, start of the channel, market channels for 2 or 3 legs up, and then evolves into a trading range. Now there's probably support here. So micro channel down to 72, but now we're at support. So the market may pull back here and bounce, but probably sellers above 72. Micro channel, first reversal up, will probably fail. I kind of sound like a broken record as I say that. Probably sellers above 72, second leg down likely. Hesitation on bar 73, trying to break out on bar 74. On a lower time frame chart, it's probably 3 legs up to resistance. So 74, not ideal for buying. It's right in the middle of the trading range. The trading range being here. And because of the micro channel down, a second leg down is likely. So now you have maybe 3 or 4 legs up, 75. And then we got that bear breakout. The bears get their second leg down. Bear micro channel, pullback, second leg, testing support. So once again, 76. Great looking bear bar closing on its low. But is it a sell vacuum test of support? So I've showed this example a couple of times today. Would you rather sell the close 76, stop above 76, with a profit target, a measured move down, or take the opposite side of the trade if you're betting that it's maybe 3 legs down to support at least 2 legs, micro channel, pullback, possible second leg trap at support, low in this trading range up here. You could buy the close 76, put a stop and measured move down, betting that the bear breakout fails and the market comes back toward the middle of the range. Basically take the opposite side. Instead of sell the close, stop above, target below, you buy the close with a target above and a stop below. The market ended up going more sideways to up, eventually getting that target on the last bar of the day. So channeling up here, many pushes with overlapping bars back to resistance. So if the market, now it's a channel. If it wasn't the end of the day, there's probably sellers in this area as the market tests resistance with maybe 4 or 5 legs up in this lower time frame channel. Okay, that's going to be it for today's end of day review. Thanks everybody for watching, and for more information on price action fundamentals and how to trade price action, please visit the Brooks trading course. There's a link in the description of this video. And thanks again everybody for watching. I hope everybody has a good night.